Introducing a series on Keltner channels used in technical analysis. This indicator centers around an exponential moving average that's often set to a default length of 20. This serves as the middle or center line. Then there will be a line below and above this middle line to form the upper and lower boundaries of the channel. By default, these lines are set to be 2 average true ranges or 2 ATRs away from the center line. So the upper line is 2 ATRs above the center line, and the lower line is 2 ATRs below the center line. This construction is similar to the Bollinger Bands indicator. Bollinger Bands differ in that their upper and lower boundaries are spaced 2 standard deviations above and below the middle line. This middle line at the center of Bollinger Bands is also slightly different in that it's based on a simple moving average rather than an exponential moving average. However, it's still also often set to a default length of 20. If you are interested in learning more about Bollinger Bands and average true range, I've already made series on those two indicators. So it might be a good idea to watch those before continuing this series. Now for a direct side-by-side comparison. The blue exponential moving average middle line of the Keltner channels will usually only differ slightly from the orange line of the Bollinger Bands. They are quite similar in how they approximate movement on the chart. In contrast, a real big difference will be seen when adding the upper and lower boundaries for both indicators. Because the width of Keltner channels are determined by average true range, they will often be narrower and smoother than Bollinger Bands that have much more drastic contractions and expansions from being spaced based on standard deviations to better represent changes in volatility. One effect of this difference is steeper movements like this uptrend can tend to have price remain outside the boundaries of the Keltner channel far longer than outside the boundaries of Bollinger Bands. The chart examples in the following series will be short but detailed, showing developments related to Keltner channels before, during, and after important events happen on the chart. This will highlight common uses and preferred conditions for the use of Keltner channels, as well as discussing less desirable conditions and showing cases where this indicator could be less effective or even cases where it fails. Chart examples will be from a wide range of markets, market conditions, and time ranges. So no matter when you watch this or which particular charts you choose to apply Keltner channels to, general information from this series can be of use to you.